All right. Welcome, everyone, to our first collaborative presentation between Davis and Hodgdon CPAs and Copperleaf Financial. Um, for those of you that don't know me, my name is Matt Cleare. I'm a CPA and CGMA. I'm a partner here at Davis and Hodgdon CPAs. I've been in the profession for the last 17 years, and here at the firm, I'm heavily involved in the tax side of the practice. And I've got here with me my colleague from Copperleaf Financial, Bree Sykes as well.
Hey everyone, I'm Breanna Sykes. Bree Sykes, if you've already met me, you know that's my, I'll tell you right off the bat, I go by Bree. I'm a senior financial advisor over on the Copperleaf side of things. So whereas Matt is very heavily involved in the taxes, I'm very heavily involved in planning, which is why we are joined together here today to kind of go over the two sides of the house and how we work together.
All right. Um, let's jump right in here, and our facilitator would be so kind to bring up slide number 2. Perfect. We're going to cover a few things today, which is we're going to give a overview on the 1040, which is the individual tax form itself, and really focus in on some of the main sections that, the forms themselves can be pretty expansive. Um, and we're going to zero in on some of the main sections that everyone really should have at least the cursory understanding of if you really want to understand your tax filings. We're going to hone in on some of the more important and commonly misunderstood line items, and then we're also going to talk about some insights that you can draw from this information. For the entirety of today's presentation, we're going to have everybody be muted, but if you want to go ahead and put questions into the chats as we go, we'll stop at various points to address any questions that do build up as we progress. So let's jump right in with the 1040 overview. Um, we can go to the next. Perfect. Uh, so there are two main pages to the 1040, which are the 1040 proper. It's 2 pages, and that's where all of your key information is really summarized. What we're looking at right now is page 1, and in particular, I want to hone in on 2 line items here that I've highlighted, but if we go to the next slide, I zoom in for anybody with old eyes like me. Um, Line number 11 is what's commonly referred to as adjusted gross income. This is an important number to know how to find and to at least understand a little bit about how it's calculated because it ends up being important in a lot of the phase ins and phase outs that you see relative to returns. Think about ability to make, say, Roth contributions, or it can also impact things like how much you can give each year with respect to charitable deductions. And then line number 15 is your taxable income. So this isn't going to tell you how much you owe, but this is going to tell you effectively how much of your income is going to be taxed or at applicable rates. Page 2 is going to be the bottom line. Um, and before I get completely off page 1, I do want to, the other thing that's particularly important to understand about your adjusted gross income, which I meant to mention just a moment ago, is that's the figure where your state returns pick up. We're going to focus very much on the federal forms and the federal tax return and all the related implications and insights here. But the adjusted gross income for most states, and certainly for Vermont, is where those state tax calculations start up. So anything below that line 11 doesn't really factor into how your state taxable income is going to be calculated. Which brings us into page 2. Um, this is where you get to see any tax credits that you have for the year that gets to reduce that liability. Um, the total tax as it's calculated prior to any of that. This is where you'll find summarized information on how much you had withheld, how much you've made in estimated payments over the course of the year, and ultimately whether you do a refund or whether you owe anything, and if so, how much. Um, so this is the bottom line, and page 1 is really how you got there. A lot of the information you find on page 1 and page 2 are summarized and subtotaled. So you're not going to necessarily get the full detail on the face of the forms, but that's where it all gets brought together from all these supplementary schedules that we've got, and now we've got letters and numbers. Well, previously we just had forms and lettered schedules. And if we can move forward one more, this is not an exhaustive list of where that additional information can be found in detail, but these are going to be uh, the most common and probably the most important ones for everyone here to understand a little bit what they are. Schedule A is going to be if you are an itemized deduction taxpayer, and many of us aren't currently under the current tax law. It's hard to get over the standard deduction, but that's where you're going to find the details on what's being deducted and how much. Schedule B is going to be a summary of all your interest and dividend income. Schedule C, if you're a sole proprietor, so you don't file a separate return for your business, which is a number of people here, that's where you're going to see all those items of income and expense summarized. Schedule D is where you're going to see all your capital gains and losses summarized, not necessarily always the full detail there, but that's where it's all brought together. And so this is things like stock sales or, capital gain distributions are all going to be summarized there. Schedule E, which is referred to as the supplemental income and loss, but for most people to make it simply, that's where you're going to find information on rental properties if you have them, and on K1 income from a pass-through business if you have that. Schedule SE is going to calculate and show the details of how your self-employment taxes are calculated if you're somebody who's subject to self-employment taxes. And then we also have some numbered schedules, which are going to summarize um, additional income and adjustments to income is really kind of a catch-all of things that aren't captured on page one. It's a whole exhaustive list of items that just you don't need that much detail on the face of the forms. Schedule 2 is going to be reporting additional taxes that you may pay, things that are calculated in addition to your sort of core income tax. And then Schedule 3 is going to detail any additional credits or any tax payments that were made um, with a level of detail that it's easier for you to see exactly where it's coming from. And I would say, Schedule 1 and Schedule 2, 3 tend to be more universally important schedules. Schedule 2 can be important as well, depending on, what kind of income you have and overall how much taxable income you have. But the Schedule 1 and Schedule 3 are probably the more important ones for most people to at least understand where to find that information. If you've got a question on page 1, this is where you're going to find the details. All right, let's get into identifying some income. And so I've got kind of a simplified formula here on this next slide. Gross income refers to the summary of all your items of income. So this is going to be all your W-2s, all your K-1s, all your stock sales, all your interest, all your dividends added up into that gross figure. So think of that as like kind of the pot of all the money you made over the course of the year before we take into account any of your adjustments or credits or anything like that. Um, Adjustments are going to be commonly referred to as above the line adjustments because they're above that AGI figure. Those are going to be things like, did you contribute to an HSA? If you're self-employed, do you get a health insurance deduction? If your income is within certain phase outs, do you have the ability to deduct student loan interest? Those sort of subtractions that happen before we get to that adjusted gross income figure. And it is worth understanding some of those adjustments as they can play into how certain things either phase in or phase out in the federal return. And again, that AGI number is the number that feeds into your state income tax filings in most cases. Um, After adjusted gross income is when we get into deductions. And again, you're either a standard deduction taxpayer or you get the ability to itemize your deductions. And that's where things like mortgage interest, property and state taxes, medical expense deductions come into play is on that Schedule A if you're an itemized deduction taxpayer. Um, if you have passed through business income or Schedule C income, which many of the people here today do, we also have currently something called the qualified business income deduction, and that's that 20% deduction that you get for certain types of business income that flow through to a return, and that's how we arrive at taxable income. Um, we can go into the next. May have jumped ahead a little bit too much in my narrative, but gross income is, and you won't be surprised to understand that the IRS defines gross income as basically every dollar that you receive for anything ever, with very limited exceptions. But the presumption is if you made money or you got money, that it is income unless it falls into one of these exemptions, things like gifts. Um, and so there's some of the more common examples, but it's really kind of anything that you made money with over the course of the year feeds into that gross income category. Um, From here, we've got some above the line deductions, which is again above the line or below the line is just simply referring to your adjusted gross income. That's that key sort of point where a lot of the calculations kick off on your return. Um, and so these are adjustments that you get regardless of whether you're a standard deduction taxpayer or an itemized deduction taxpayer. Um, and again, so it's self-employed health insurance, student loan interest. If you make individual retirement account contributions that aren't through an employer-sponsored plan, this is where you would see the deduction for things like a traditional IRA. AGI is just the simple function of the two. It's the entirety of your gross income minus any of your allowable and applicable adjustments. Um, which brings us into our two different types of deductions that you can have applied to AGI. The standard deduction is a specific amount. It depends on your filing status, and it can depend on your age or if you are blind. And so you get a little bit of a kicker added to your standard deduction if you fall into one of those categories. For 2023, these are the amounts that were here. This is for those who can remember back to the Tax Cut and Jobs Act. The standard deduction was pretty dramatically increased with the passage of that act. And some of the deductions you can take on your itemized deductions, things like property taxes and state taxes, were capped. And so that's what effectively moved many of the people here in this presentation from being itemized deduction taxpayers to standard deduction taxpayers. But there are still times when um, your itemized deductions can be significant enough that you have a benefit of being an itemizer. We get into that here on the next slide. So this is information about certain types of deductions that if you add them all up and they exceed the standard deduction you would take, and that information is going to be summarized on your Schedule A. So if you turn to Schedule A on your return, this is where you're going to see how all that adds up. The most common things you'll see here are the state and local taxes, which are, sort of the sum of any state income taxes you pay and property taxes that you pay on your primary residence at least. And that's what's been capped at $10,000. So for many, many, many of the people here, you'll see that that number, no matter how much you actually put into the information on the Schedule A, is capping out at 10,000. Mortgage interest gets deducted here. Medical and dental expenses and vision as well, to that point, that exceed 7.5% of your adjusted gross income. So this is one of those calculations I was referring to previously where your adjusted gross income is important because your adjusted gross income is what is going to set a floor that allows you to either get some benefit in deducting your medical expenses or prevent you from getting any benefit in deducting your medical expenses. And this is also where in the federal return, you're going to see if any charitable giving you've given over the course of the year is going to be significant enough that it would move you into a category where you get some benefit to that. And with that, I am going to turn it over to Bree for a moment just to talk about some of the ways, particularly with charitable giving, that you can, with a little bit of strategy, uh, be able to take advantage of those itemized deductions in a given year.
Yeah, thank you. If we can go to the next slide, we've got some examples. Thank you. So this is where I feel like the fun part of planning comes into play. A lot of times when we have clients that we're working with, we're building out a financial plan. It can be really stressful. You're talking about your expenses and how you're going to get through retirement and beyond. And There's a lot of spending going on, but then we get to a point where you have excess funds and you are very charitably inclined and you'd like to figure out the best way to use those. And this is where the magic happens. So we have a few options that and if you're a joint client, we tend to work side by side with the tax side, planning these out for you to present what are the best opportunities and why would you do one over the other. But for this purpose, I just wanted to briefly explain what the main three are. If you are charitably inclined, you might have heard something like a donor advised fund or a DAF. This is really effective when you're bunching or putting years worth of funds together in 1 year. To Matt's point, getting you over that standard deduction. So if your standard deduction is like the 27,700 and you're only donating 23,000, you can't itemize that. You can't get above that deduction. So here we'd start working the numbers and seeing what makes the most sense. Maybe if you do, 25,000 a year, we would bunch 2 years together to get you 50,000 to get you over that standard deduction and provide some tax benefit to you. This is going to look different for everybody. So we run these numbers annually for each person and just talk through that opportunity. But the donor advised fund is really nice because you can put that money in for 1 year and then spend time the next multiple years pushing that out to your charities of choice. So just because you're doing, let's say, 50,000 1 year, doesn't mean all of that's going directly to the charity that year. It's going into the fund, and then you can disperse that, similar to how a foundation would work. You get to choose where those dollars go. You can also donate appreciated stock. So just like Matt had mentioned, you're going to see those gains and losses on your tax return. And even before that, we're going to be working with you to talk about whether it makes sense to donate appreciated stock. Because if you have a huge gain in that, how can we avoid that? We can donate it and give that to the charity. And that's very tax advantage to you and to the charities. That's another way that we're looking to try to help you, not only help those that you're looking to help, but in a way, a little bit help yourself as well. And then there's qualified charitable distributions, or QCDs, you might have heard. It's funny to refer to them as QCDs because they relate to RMDs, a lot of acronyms. So if you are required minimum distribution age, or even a little below, actually, right now the standard age is 73 or 75, depending on your birth year, but qualified charitable distributions can start at 70 and a half. So these are dollars that come directly out of your IRA account, your individual retirement account, and that is going directly to charity. So if you don't know, or if you do know, money that comes out of your IRA accounts, that's income to you, ordinary income. So if you were going to take money out of that to give to charity, we would just want that to go directly from your IRA. You don't pay taxes on that. They're not paying taxes on that. It's a way to avoid that income tax for you while you have to take money out. Because if the required minimum distribution, those are dollars that the government says, hey, you're over the age, it's time to send some money and pay some taxes. You can say, no, thank you, and send that right to charity. So these are just three different opportunities that you have or may have, and that involves planning. Each one is going to be individual to each person. There's no blanket answer here, but it's really great opportunity. And as I said, a really fun way to discuss spending money and saving on taxes. So we can talk about that further, but back to you, Matt.
Yeah. And just to dovetail off of that, for a moment, if we can go backwards, just that last slide, something that I think is important to understand is just how powerful that last category is for anybody who is taking those RMDs from an IRA. We're not even talking about a Schedule A deduction at that point. We're talking about not counting it in your gross income to begin with. So if someone is talking to us about wanting to make some charitable gifts or anything like that, and this is an option, this is always the easiest answer we can give is, do you have any RMDs? You want to take us to qualified business income. So qualified business income is going to apply to many, many, many of the people here. Um, and so thinking back again to the Tax Cut and Jobs Act, it created a deduction for anyone who's self-employed or owns a small business that ends up on their being reported on their individual tax return, where they get to take a 20% deduction against that income. It was meant to be a tax cut specific to small business owners to really encourage some economic growth being driven by small business owners. Um, there are some phase outs that can apply, but don't necessarily apply in every situation. So income, this deduction can potentially start to phase out once you get into taxable income categories, which are taxable income before taking into account QBI. If you're married filing joint, that's right around 364,000. Or if you're any other filing status, that's going to be right around 182,000 is when phased outs may or may not apply. For many businesses, they don't ever really end up effectively phasing out. For other businesses, there's no choice but to phase out. And without spending a lot of time on that, uh, you would know if you're a specified service trader business because you probably heard from me about that before now. So that gets us through a lot of how the forms are, how they're laid out, some of those key categories of how gross income's calculated, deductions, adjustments. Now let's talk about some insights from the perspective of things that are really important to understand mechanically. And if you can take me into this next slide.
We do have one quick question, Matt, if you want to answer
Yep,
it now.
absolutely.
We have a question that came in that stated that they manage their own rental property, don't have a W-2 job. Does this allow me to deduct medical insurance costs?
Often it doesn't. This is going to be a technical answer that is very specific to the facts and circumstances of the individual asking it. So I'm not going to give a generic answer other than often when it comes to rentals, you're not going to qualify for that self-employed health insurance deduction, but not always. Sometimes rental activities, depending on the facts and circumstances and depending on what else you have going on in your tax picture and just whether or not you have a W-2 on its own isn't necessarily enough. Um, but that can be an important factor to consider on whether you can truly consider that to be kind of a self-employed activity or not. Um, but that is a question that's worth exploring with us kind of offline if it's not something we're already taking advantage of for you or haven't already flushed out. But the kind of default answer is no, but I preface that with a but. All right. So there are two important rates to understand within the context of your return. And I'm going to spend what may seem like too much time on this topic because it is one of the most commonly and most dangerously misunderstood concepts. And I'll give an example of that that's very personal uh, to me. And that is the concept of what your marginal tax rate is and what your effective tax rate and what I mean by that is marginal tax rate tends to be what most people understand and think about when they think about their taxes, and that's the brackets. What bracket am I in? What's the what percent taxpayer am I? And the effective tax rate is going to be when you add up all your income and you see what percent of that income you actually paid taxes on, how much did I end up paying? Like my total tax versus my total income full stop. What percentage of my total income am I paying effectively as a tax rate when you combine all my items together? The reason why that's important is many people have the perspective that the marginal tax rate, when you graduate to that next bracket, um, all your income is suddenly going to be taxed at that next marginal tax rate, and that is a common and dangerous misunderstanding. You never lose the benefit of the lower tax rates. It's just every dollar above where you kind of phase into the higher tax rates gets taxed at that new rate. And so that's why your effective tax rate is, for all intents and purposes, in any scenario I can think of, always going to be quite lower than your marginal tax rate. Um, and where I've talked to clients and where I've talked to friends and in my own experience, I can think back to before I even knew what a CPA was back in high school. We had a close family friend who was, uh, it sticks out in my mind to this day. Who was bragging to me that their mortgage didn't cost them anything because the interest brought them down into a lower tax bracket, which saved them so much in taxes that they ended up paying for their mortgage. And that just simply is never going to be the truth once you understand the mechanics of how this all works. Um, so if we get into our next slide here, kind of already touched on this, and I guess what I'll add to it is really that the US has what's considered to be a progressive tax system, and that's not necessarily a political term here as much as it's as you earn more, in theory, your tax rate is going to increase. The theory behind that is that somebody with $1 million of income isn't going to feel the same hit on a percent basis as somebody with $50,000 of income. Or 25% of your income at $50,000 is going to really affect your quality of life in a much more profound way than 25% of somebody's income if they've got $1 million in income. Um, and that's the amount that once each time you graduate a bracket, every dollar that you earn above that point is going to be taxed at the higher rate, not the entirety of it. So if we go into the example, which I think will help illustrate it better than I've explained it. So if we look at marginal tax rate for a single filer with taxable income of $200,000, and you go into the 2023 brackets, in this instance, they would find themselves in a 32% marginal rate. Um, if we go into bring this all back together here in just a moment, but the common misconception is all of that income is going to be taxed at 32%. And the reality is um, between 95,000 and 182,000, they're paying taxes of 24%. Between 45,000 and 95,000, they're paying taxes at a rate of 22%, and so on and so forth. And if we go into how the effective tax rates actually work on our next slide, and this is the percentage that you actually end up paying. And so in this example, what is the effective tax rate for somebody who a single tax filer who made $200,000? I've included a lot of math, but that's just to illustrate. So you see that 0 to 11,000, they're paying 10%. From 11,001 to 44,725, they're paying 12%. And you see the amounts that are being taxed there. So effectively, if you add up all the brackets that they've shot through to the point, the marginal tax rate that they're in, you'll see that the total taxes due are 42,800, which is an effective tax rate of 21% that they're paying. And the reality is they're really only paying 32% on $17,799 in the grand scheme of things. This is an incredibly important thing for every taxpayer to understand because it prevents you thinking back to, that close family friend I was talking about who was making otherwise what might be considered bad financial decisions because in their mind, it kept them out of that top tax bracket and they were saving so much because all their income was now being taxed at a lower bracket that it paid for the mortgage. Um, there's just so much bad advice you can find online, and bad advice that gets paid around with a really fundamental misunderstanding of how these tax rates work and are applied to your return. Um, any questions here? I just want to pause for a moment and encourage if there are any questions or if I haven't been clear enough on what I'm trying to break down, because I do think this is a fundamental topic that everyone should understand.
We do have a question that popped through. Excuse me. When the time is right, I'm assuming she means when we ask this question. Please advise about this. Our first grandchild was just born. Yay, congratulations. What is the best way for him and for them to save for his future and shelter taxes? And then what is the limit on that kind of gift for a grandchild?
So you're not going to love this answer, but I am going to say a lot of this depends on very individualized facts and circumstances. There isn't one blanket answer, and I do want to let Bree kind of share some thoughts around here as well, because a lot of this is going to be more in the financial planning wheelhouse. But in terms of the lift or limits around what kind of gifts can be given to grandchildren, there aren't any limits to what can be given as a gift, but there are lifetime exclusions before the person giving the gift might have to worry about paying what's effectively an estate tax on that. Um, Currently, that's north of, I forget what the exact dollar figure we're at right now, but I believe you get something like 11 or 12 million federally per spouse before you have to worry about that. Um, and there are no gift implications when it comes to Vermont state taxes. I'm not going to get into some of the other states, but there could be strategies around uh, gifting out assets prior to someone's passing to avoid the Vermont estate tax. There's just no related implication for giving gifts ahead of time. I don't know if there's any more generic ideas or thoughts that you want to feather in there as well, Bree.
Yeah, as Matt said, it is unique to you, but there are some opportunities. It really comes down to what your goal is beyond saving taxes, what your goal is for those monies for the grandchild. Um, if you're talking college, there's definitely some opportunity there. Vermont offers a tax credit if you're contributing to the Vermont 529 plan. You get a 5% credit up to $5,000. So if you put in $5,000 per beneficiary, you get 5% in a credit. So $500 back, and that's per beneficiary. So if you have more grandchildren, you can open up those same accounts for them and kind of accumulate those credits. If your goal is something else other than college, then we really have to try to nail down and see what that goal is and what opportunities are out there for you. But we definitely would be happy to have those conversations unique to you and see how we can help.
All right. I'm seeing no other questions at this time. I want to jump into what may be kind of a less common, but not, looking through the list of who's here, this is going to be a concern to some of you, and that is a little bit on how Social Security specifically is reflected on your return. So when it comes to your federal return, Social Security it can be a little bit of a wild card because whether it's taxed and how much of it is taxed is largely dependent on how much other income that you have. And so what this slide breaks down for us is in the respect whether we're talking about a single taxpayer or somebody who's in a married filing jointly status, where those phase outs are. So for instance, if you're married filing jointly, and your modified AGI, which is kind of it's a play on the adjusted gross income calculation that I was referring to earlier. And I'm not going to go into the details because it's a little bit uh, archaic in how it's calculated. Um, but if your modified AGI, which is going to be pretty close to your AGI before Social Security, is less than 32,000, you don't pay taxes on any of it. If it's in between that next range, 32 to 44, you're going to pay taxes on the lesser of either 50% of the benefits that you get or the modified AGI in excess of the 32,000. And there's instances within that kind of phase in range where either one of those could be the lesser figure. And if your modified AGI is going to be more than 44,000, and again, these figures are applicable to last tax year, 85% of the benefit income is taxable. And that's going to be the most of Social Security that is taxable for anyone. Um, Many people find it pretty easy to get into that 85% taxability. But for those who kind of teeter on the borders of it, um, this can be where planning around those other income sources, whether or not to sell stocks and recognize a gain, whether or not to do that QCD, can have a much bigger effect than just whether you have taxable income for just that event, if it's going to cause your Social Security to be taxable or more taxable than it otherwise would have. Um, so that's one of those things where you can have a ripple effect where the decisions you're making in one area also impact what's taxable in others. Social Security being one of the main ones to understand if it's applicable to you. Um, and then I do want to spend some time here on some specifics around the Tax Cut and Jobs Act, which you've heard me refer to a few times today. Um, so this was big legislation originally passed in 2017. And the reason why I'm spending a bit of time here today is because large chunks, if not most of what's going to affect any individual taxpayer are set to expire after 2025. And for many people, that's going to mean higher taxes. Not everyone, but for many people, that's going to mean higher taxes starting in 2026. Um, when it was passed, it was and still remains to this day to be one of the most significant pieces of tax legislation in 30 years. And to help illustrate some of the things that the Tax Cut and Jobs Act changed and that are, if no legislative action is taken, are set to expire in 2026. If you can bring us to our next slide here. So these are what the current individual tax brackets are under the Tax Cut and Jobs Act compared to what they were prior to the Tax Cut and Jobs Act. And so you can see, same for some of the lower or for the lowest bracket, but pretty quickly after that, you can see it's quite the increase in um, tax rates for each bracket, um, all the way up to our top payers. One of the things that one of the ways this is going to be most profoundly felt, that first paycheck in 2026 is when withholdings are changed to account for this. Um, so the first time that people feel the impact of these tax changes, and the first time that everybody needs to be aware that this is coming for their own financial planning purposes, is not going to be, April 15th, 2027 when you're filing that return. It's going to be with those first paychecks that you receive in 2026 because the withholding tables are all going to need to be adjusted to accommodate this. Um, if we go to the next slide here, this is what I was referring to earlier with the big increases we had to the standard deduction. Um, Pre-Tax Cut and Jobs Act, married filing joint return was only 12,700, or would be. 2024, so this current year, it's going to be 29,200. So after 2026, or for 2026 tax years and beyond, we're going to be reverting back to those standard deduction amounts. And so when you combine that with some of the other phase in, phase out things that have occurred, including what is most meaningful is the SALT cap. That stands for state and local income taxes. So that's that $10,000 cap that was placed on state income taxes and property taxes combined. When that goes away and the standard deduction is reduced, it's becoming a lot more important for everybody to really track their itemized deductions again. Many of you who've been with us for years may remember that, for instance, and an example of this that will come into play for the 2026 tax year, is, at the end of the year, tax planning always used to be try to figure out what you're going to owe the state so you can write the check before December 31st. And we were able to lay off that because if you're capped at 10,000, there's not that much play there. Um, we're going to be back into a situation where strategies like that are going to start to make sense again. So many people who haven't needed to do any sort of substantial tax planning, um, really since the passage of the TCGA, are going to be back in a situation where there may be significant implications to, in particular, the timing and how much you pay in state income taxes. Um, it also changed things like how much benefit potentially we could get for charitable contributions by the caps that put on itemized deductions, but also how much you could actually deduct in a given year, which ended up being favorable under the Tax Cut and Jobs Act. So they took away our ability to get some of our itemized deductions, but they allowed you to be more charitable if you're charitably inclined without it, where you could still take the benefits of that on a return. And so here, if you look at what this chart is telling us, which is the way that your charitable contributions are capped, which isn't, to be honest, isn't a limit that we bump into often, but you'll find it in years where somebody has a lot of income or they decide that they want to, set up that donor advised fund, um, is you're only allowed to give and deduct a certain percentage of your adjusted gross income. So we're back to page one on your tax return, that adjusted gross income figure. Before the Tax Cut and Jobs Act, you couldn't give and deduct more than 50% of what your AGI is. After the Tax Cut and Jobs Act, they bumped that up to 60%. And then if you go to our next page, this is what I was referring to with that lifetime exclusion for estate tax purposes. So for that question we got earlier around, are there any limits to what I can give? There aren't really limits to what you give, but this is where you're potentially looking at potentially having some tax implications should you give out more than these amounts over the course of your life. And so you will see that they were significantly increased by the Tax Cut and Jobs Act, what these lifetime exclusions were. And we've got what each individual has for an exclusion for themselves and combined as a married couple. Um, and then what they're going to revert back to after the sunset of the Tax Cut and Jobs Act. I will throw in though, for many, 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 if not the majority of our clients, 7 million individually or 14 million as a married couple is still well above what they need to worry about. So I would say for the vast majority, if not the entirety of everybody who's here, you don't need to be super concerned about the estate tax limits when it comes to your gifting strategies. Um, what there can be some uh, commonly misunderstood implications to is the need of whether you need to report a gift. Often you'll need to report a gift because it's over certain limits, which are reset annually. Um, but that doesn't mean that it's taxable. They're just tracking it over the entirety of your life to see if you're bumping into these lifetime exclusions. So it's really just an informational disclosure that needs to be filed. Um, so if we go to our next slide, this is just speaking to that $10,000 limit that was placed on will be off, which again is going to make it a lot more appealing and a lot more beneficial for certainly anyone living in a higher tax state like Vermont is, to be able to deduct those taxes on their tax return. And then another material change that doesn't affect everyone, but I would guess affects a number of the people here is the alternative minimum tax is going to become much more relevant. This is something that never went away, but some of the changes and exemptions that were applied with the Tax Cut and Jobs Act made it much more of a rare occurrence that anyone ever really found themselves in that alternative minimum tax. And so for many of you that have been with us for a number of years, this is another thing we often planned around was how to keep people out of the AMT. Because it's somewhat punitive alternative tax calculation method that if you're in it, takes away a lot of your options to lower your taxable income and lower your tax rates. And then the last bit that I want to cover, that's particularly important to understand about what's coming up in the not so distant future is for all of our self-employed people, for all of our small business owners, this 20% deduction that we've all effectively gotten used to is in all likelihood, absent legislative action, going to be gone. Um, and so what that means is even in a potential situation where you may be looking at less income in the future past 2025, that doesn't necessarily mean you're going to have less taxes. Combination of higher rates and the lack of a pretty significant qualified business income deduction means that just not that everyone should be losing sleep over it, but everyone should be prepared that come 2026, um, it's most prudent to be prepared that tax burdens will be going up again. And with that, we've left a little bit of time now to get into any additional questions or concerns that may have come up. Um,
We do have one question that popped in, Matt, just what constitutes a gift?
a gift, this is an interesting philosophical question. From the perspective of the IRS, a gift is going to be a payment to another individual that isn't taxable income. So you're giving something to someone. If you're a business owner, it's not a deduction to you because you're giving them something, so it's not an expense on the other side. Um, a gift would be transferring property to an individual, giving them cash in a way that isn't remuneration for any services performed or any sort of a consideration. You're not getting anything back for it. I'm just truly altruistically giving it to this individual. Um, hope that answers the question. If you had more specific concept that you're wrestling with that led to that question, I'd be happy to speak more specifically if you put something else in the chat, if that didn't answer.
The follow-up to that would be, does the individual have to pay tax on the gift?
Okay, that's a great question, and it's a commonly misunderstood one. No one who receives a gift ever pays tax on that gift. Full stop. So the person receiving a gift, it's never a taxable event to them. Um, where taxes can come into play is if the person who's giving the gift has given so much over the course of their life in gifts that they're bumping into those lifetime exclusions, which are 20 something million for a married joint couple or 14 even after the Tax Cut and Jobs Act. That's when the estate tax may come into play for that person giving the gift, not the person receiving the gift. Um, and so the only question, and even if there's an informational return that's required for the person giving the gift, that doesn't impact the individual receiving the gift either as well.
We have a couple follow-up on this. This is a hot topic. So one person would like to know if
Excellent.
jewelry would be considered a gift.
I uh, I think I can pull this up too. You bled out for a moment there. Jewelry. Yeah, jewelry could be a gift. Absolutely. Property. It doesn't have to be cash. Um, It says, what about giving employees a bonus each year? Is that a gift? A bonus is supposed to be reported as W-2 income. So anything where you're paying money to your employees each year, that's W-2 income. There's really no exclusions to that as far as the IRC is concerned. If you if you truly out of your own pocket give something to someone, um, and they happen to be an employee, I might still caution you against that, but if you're not deducting it and you're truly treating it like a gift, that can be a way to do that. But you're not going to be there. There are no situations where you can have a deductible expense that's considered a gift to the person, where taxable income is essentially disappearing. It's a deduction on one end and it's not income on the other. That's not going to be something that plays out. Um, would paying for someone's college bill be considered a gift? Um, yes, in most, yes. I mean, that's now whether or not we're in a situation where gift return has to be filed in the relation, there can be considerations around that, but in most cases, I'm going to say paying an expense on behalf of someone is going to constitute a gift. I
Just
think Bree can speak to some of the specifics around higher education and where or where not that would be reportable or not. Um,
yeah. So the when you say this does say college. So if you're paying for tuition for somebody and you're paying it directly to the school, it's not filtering through that person. That's not a gift. That's you're paying the tuition directly to college. So we'd have to talk of specifics. But if you're because I say specifics and I know it's hard. We all want blanket answers, but I want to be clear in how that's processing because if you're asking that question, but you're actually giving that money to the person and then they're paying to the school, that's different versus you just taking that dollar and you're giving it to UVM and you're paying your child or your grandchild's tuition. That's different. That's not taxable or not a gift. Sorry.
right. I think I may have misread that first part.
Oops, I moved
Um,
it.
Tax implications for inherited dollars. The person receiving the inheritance, there are no tax implications. If you inherit money, it's not taxable to you. It's again going to apply to is the total value of the estate over that exclusion amount? And is it over that exclusion amount when you factor in all the gifts they've given over their lifetime, and what they've tracked for gifts that they've given away? Um, so for the person receiving an inheritance, there is no tax implication. What there can be, and I'll mention it here even though it's not in the question, is often an estate has to file and pay taxes on its own relative to, so say someone passes and they have a whole lot of investment accounts out there, and those investments continue to generate taxable income from the point that the individual was deceased to when those assets are ultimately distributed out of the estate to the recipients. That income that the estate earns is going to be taxable income, but that doesn't mean that the individual who's ultimately receiving it is going to be taxed on those amounts. It's a much smaller piece of the pie overall, but that is, if you're trying to reconcile, you get this big estate exclusion versus uh, many people be familiar with the state tax returns. That can be something that triggers that need to file and pay taxes on behalf of an estate, even if you're below those lifetime exclusions. Um, Tracking gifts. The if you're over the exclusion, um, which individually for last year was 17,000, which means that if you gave less than 17,000, you didn't need to file the informational return. You double that for a married couple, they each get the same exclusion. That's when you file that informational return with the IRS, and each time you file that informational return, you add up the total of what you've given over the course of your life. So that's the mechanism by which you're reporting it to the IRS, and really the main one that most people use to track what they've given. Um, Yep, that limit is the 17,000 for last year. It's indexed though, so that does change over time. And again, you double the 17,000 if you're a married couple. Uh, the next question here, the Vermont exclusion, I did not have on the tip of my tongue, but I believe it's somewhere in the neighborhood of 5 or 6 million for what's the total estate exclusion that you're allowed. But Vermont doesn't hit you with gifts. So that's where, um, say your total estate for a married couple um, before the expiration of the Tax Cut and Jobs Act is well below the 27 million that you get for free from federally. But it might be in excess of that Vermont. Um, it's right around 5 or 6 million, I believe, currently. Bree might, I don't know if you happen to know the figure off the top of your head for the Vermont exclusion.
No, I think you're talking about gifts, though. I think she's asking the estate
I think
exclusion.
the state exclusion. Yeah, I think we're talking about state taxes.
Okay.
Um, but that's where, so Vermont doesn't track your gifts and it doesn't penalize you for giving gifts. So you can find instances to work with good financial planners like Copperly Financial to work around not finding yourself in an instance where at the end of life your state is potentially facing Vermont taxes even though you're below the federal exclusion level because gifts will reduce the estate for Vermont, but they don't for federal purposes. Um, there is, it's not even so the next question is there an annual max on gifts or just a lifetime cap? And the truth is, there's neither. It's a lifetime exclusion, right? You can give more than that. It's just once you exceed the exclusion, you're potentially paying those estate taxes, which are at a purposely punitive rate. I mean, not punitive, but a higher rate. Um, so there's never any limits on what you can give. There's just a certain point where you are creating a taxable event for the person giving the gift, never the person receiving it. Um, and there is no annual max. There's just that 17,000 that you get to give without needing to file that informational return, right? So that's commonly referred to and misunderstood as a maximum amount of the gift, and that's just simply not true. That's just the point that once you've given more than that, you have to file that informational return to essentially create a record of the gift with the IRS so they can start seeing how much of your lifetime exclusion you've given away.
Well, I think that's all the questions popping through. I'm really excited. We have a very charitable group of people paying attention, which is great.
Yeah. Well, if there are no more questions, we're going to go ahead and roll through our fine print. Um, Give everyone a moment there. And then we also have some sources that may be useful on the next slide. I'll just take a moment to thank everyone for making time to go through this with us today. And thank you to Bree and thank you to Leah for handling our slide deck today.
Yeah, thanks everyone for joining. This is recorded. I know a couple of people had asked that question, and so it will be posted on our both of our websites, and we'll get that information over to you as soon as we have it all put together.